Hey guys, as you can see, I am in Bears territory at UC Berkeley with the UCLA hat, so I may get tackled during this recording. So today I want to briefly talk about Series I bonds. Like about 2 years ago, I don't know if you remember, when inflation peaked at about 8%, Series I bonds was all the hype and fire type physician groups. I don't know if you remember. So I want to share with you my quick summary of Series I bond. So Series I bonds are US savings bonds where you essentially loan money to the US government. The I in I bond stands for inflation, which means the interest that the bond pays is based on the current inflation rate. So the bond interest is a current inflation rate plus roughly about 1%, and the rate is adjusted twice a year in May and November. So when the inflation was 8%, the bond was paying over 9%, which made it very, very popular at that time. It's not as high right now because inflation is much lower. So here are some of the pros of I bond investing. So number one, you're not going to lose money in a practical sense because you're loaning money to the US government. They're not going to default on your money. And also, money is protected against inflation. So, number two, you don't pay state and local income tax on the bond interest, which I think is one of the best tax benefits, especially for those who live in like California, where state income tax is very high. So, number three, you don't have to pay taxes on the interest that you receive because it accumulates annually, and you pay taxes when the bond matures in 30 years or when you dispose of the bond. You do have an option to elect to get the interest payout annually, just like regular savings bond, but that's only when you elect to make that choice. So number four, the bond interest can be redeemed tax-free. So listen up. If you use the redeemed interest for qualified education expenses such as tuition for yourself or for your children, the bad news is the income limit. So only those whose income is roughly below 170 when filing joint as married couple can be eligible to take this tax-free redemption of the interest. So not generally for physician couple. Additionally, if the bond is purchased in the name of a kid or youngsters younger than 24, then the tax-free interest redemption is not available. So if you have your toddler buy the I bonds, then your kid can't redeem it for college tuition tax-free. That plan won't work because of the age limitation. So here are a couple cons. So number one is the amount that you can purchase. You're only limited to $10,000 of I bond purchases a year with cash and additional $5,000 with tax refund money. So you can't really buy, 100,000 or 200,000, whole lot of money like 529. Number two, you cannot easily pull the money out after your bond purchase. So you have to keep the bond for at least 1 year. You can't redeem it. If you decide to redeem it within 5 years, you'll be charged 3 months worth of interest as a penalty. So your money is essentially locked up for a few years. So the bottom line is that I bonds are generally appropriate for those who are in the wealth preservation phase, not me, because you're not going to lose money, but you ain't going to make much money either. And also help balance your portfolio if you have high risk investments. I bought 5,000 worth of I bonds so that I can learn about it and learn about its performance and track it over time. So this is it. Hope this was educational, and I'll see you next time.